You're watching Video Vocab by BusinessEnglishPod.com.
Today we're looking at business vocabulary related to accounting. First, we'll hear a short article introducing the topic. Then we'll go over each word in detail with some example sentences to show you how you can use the words. At the end of the video, you'll have a chance to review and practice your new vocabulary.
One key summary of a company's financial condition is its balance sheet, which records all assets and liabilities at a single point in time. Another is its profit and loss statement, which shows gains and losses over a period of time. These documents allow managers and investors to easily identify critical information about the company. For example, its gross and net income, both pre-tax and after-tax, as well as the amount of debt it is carrying.
Now we'll go through each word in detail with some example sentences to show you how the vocabulary can be used. Balance sheet.
Balance sheet.
The balance sheet is a summary of a company's financial position at a specific point in time, usually the end of its financial year. A company's balance sheet should indicate the value of everything the company owns, its assets, as well as everything that it owes, its liabilities.
Our balance sheet is not as strong as last year, since we've taken some heavy losses on investments.
Asset.
Asset.
An asset is anything owned by a company that can be converted into cash or used to generate income.
Most of the company's assets consist of accounts receivable from very risky customers, and until they are paid, it's hard to be sure of their actual value.
An asset may be tangible, like a building, or intangible, like a valuable patent or copyright.
Consulting firms usually have few tangible assets, and their main intangible asset is the reputation they've established.
Liability.
Liability.
A liability is a financial obligation or debt held by a company. Some of the more common types of liabilities include accounts payable, bank loans, and outstanding taxes.
Managing liabilities effectively is critical to good financial planning.
Short-term liabilities are usually those that must be paid within 1 year, while long-term liabilities are repayable after more than a year.
Our short-term liabilities have grown very quickly this year as we expanded into new territories.
Profit.
Profit.
A company's profit is the amount the business earns in a given period, usually a year, after deducting all expenses.
Profits for many firms have declined due to a slowdown in consumer spending.
Profit margin.
A profit margin is the percentage of gross income a company retains after all costs are deducted. If the cost of producing a product is almost as high as the selling price, the profit margin will be very low.
The profit margin on luxury automobiles is much higher than on economy vehicles.
Loss.
Loss.
A loss is negative profit. If a single transaction costs more than it earns, the company is said to make a loss or take a loss on that transaction.
We've always taken a loss on our equipment sales, but we make it up by generating revenue through after-sales service.
If a company's profit for an entire year is negative, it is said to make a loss or run at a loss for that year.
Companies that run at a loss for several years may be forced to stop trading on the stock exchange.
A profit and loss statement is one type of accounting report that companies publish on a regular basis.
Debt.
Debt.
Debt is money owed by a company to another company or individual. Most corporate debt is in the form of loans from banks or bonds that have been sold to investors.
This year's balance sheet shows that the company's bank debts have been fully repaid.
See you again soon.